A stock redemption is just a corporate buyback. The corporation gives a shareholder cash or property and takes back its own stock. That stock might be canceled, retired, or held as treasury stock. On the EA exam, they'll often hide a redemption inside a business purpose fact pattern, like buying out a departing owner or blocking a hostile buyer. Redemptions happen for very practical reasons. Founders may want to keep ownership in the family. A company may go private by redeeming public shares, or they may redeem a hostile minority shareholder, retire preferred stock to stop dividend payments, or reduce shares outstanding to boost price. Exam tip: the reason explains why it's happening, but it doesn't decide the tax result. Now the corporate level tax rule. If the corporation redeems stock with cash, there's no gain or loss to the corporation. But if it uses property, the corporation acts like it sold the property for fair market value. That means it recognizes gain if FMV is above basis. And here's the painful part: it generally cannot recognize a loss if FMV is below basis. So if a corporation is sitting on lost property, redeeming with that property is usually a bad move. The classic planning point is sell the property to an unrelated party first, recognize the loss, then use the cash to redeem the stock. Also remember, redemption-related corporate costs aren't deductible as business expenses. On the exam, that's an easy trap. Next is the shareholder side question. Is the redemption treated like a sale or like a dividend? The big concept is qualified redemption, meaning the shareholder's ownership is substantially reduced. When it qualifies, the shareholder gets sale or exchange treatment, so capital gain or loss. When it doesn't, the payment can be treated like a dividend to the extent of E&P. Here's the E&P twist they love testing. In a qualified redemption, the remaining shareholders do not increase their stock basis just because someone got bought out. Instead, the corporation reduces E&P by the redeemed shareholder's ratable share tied to the stock redeemed. That E&P reduction can lower future dividend income to the remaining owners. Harborview Financial Group is a cash-basis C corporation. It distributes property with a fair market value of $120,000 and a basis of $72,000 to a shareholder in a non-liquidating distribution. How much gain or loss does Harborview recognize? The options include 0, a $48,000 gain, a $48,000 loss, or a $72,000 gain. Think about it. The answer is a $48,000 gain. A C corporation recognizes gain, but not loss, on a non-liquidating distribution of appreciated property, as if it sold the property for FMV. So, $120,000 minus $72,000 equals $48,000. The tempting wrong answer is 0, because people remember distributions aren't sales, but for the corporation, property distributions trigger gain. When you start with taxable income to compute a C corporation's earnings and profits, which item decreases E&P? Choices include the dividends received deduction, long-term contracts on the completed contract method, mine exploration costs deducted currently, or corporate dividends and other distributions to shareholders. Think about what actually reduces E&P. The answer is corporate dividends and other distributions to shareholders. Those reduce E&P when taxable income is your starting point. A tempting wrong answer is the dividends received deduction, because it reduces taxable income. But E&P is not the same as taxable income. Many deductions are added back or adjusted when computing E&P.